Guys, welcome back to the channel. Today we're going to be discussing 3 stocks that I think are at pretty good value today looking into December 2019. Now what's interesting in this video is that 2 of these stocks I've actually never discussed on the channel before, so that'll be something new for you guys. And actually one of these 3 stocks may actually be a good recession-proof stock. So pay attention. As always, if you like these kind of videos, drop a like down below. We're aiming for 550 likes on this video. And guys, if we get those 550 likes, I'll create another video on 3 dividend stocks to buy in December 2019. So if you want that video, make sure to share this with a friend to get that like count up to 550 likes. So guys, I'm going to get right into it and I'm going to reveal this to you. The first company here is actually in a sector or an industry, I'd say, that does fairly well during recessions, and this is a very specific type of retailer, discount retailer if you will, and those are dollar stores. So stock number 1 is Dollar Tree, ticker symbol DLTR. So this is the first you're hearing of this company. They are a Fortune 200 company and they operate across North America. They have over 15,000 stores across 48 states and 5 Canadian provinces, and employ more than 182,000 people. You may recognize them by their store names such as Dollar Tree, Family Dollar, or Dollar Tree Canada if you're located in Canada. So why is this a stock that I think will hold up well during a possible upcoming recession? Logically thinking, when a recession hits and times are tough economically, people tend to stop spending as much money, but they still want to maintain a pretty high standard of living. So to do that, dollar stores actually perfectly fit that mold, and they're able to offer consumers name brand products at significantly cheaper prices. Now many of you may think, well, Amazon's out there and they pretty much make dollar stores insignificant now because they can sell items for even cheaper than dollar stores. But the reality is, at least here in Canada, whenever you're looking on Amazon for something that's say under $10, they're typically listed as an add-on item, which in turn means you need a minimum of $25 in your shopping cart to get free shipping. If you don't, then you have to pay a shipping fee that ranges anywhere between a few dollars all the way up to possibly even $10 just to get that item shipped to you. So in that sense, value prop doesn't really make sense. Amazon's great for larger items or prime items which don't have that add-on requirement. But when you're looking at other items, maybe cutlery or something that's like $1 or $2, Amazon is not the best option for that. So I personally think that dollar stores have their place in the market, and I personally think that Dollar Tree here is an enticing play, especially for December 2019. So here you can see just a couple of weeks ago the company reported their earnings, which I think were not too shabby. Net sales increased by 3.7% year over year to $5.75 billion. EPS came in at $1.08 at the lower end of the guidance, but still in the range expected. And enterprise same-store sales actually increased by 2.5%. So overall, not a bad quarter from the company, and when looking at their profit, they increased their gross profit by $32.6 million to $1.7 billion in the quarter. The gross margin was 29.7% versus 30.2% in the prior year. Now they blamed this slight decrease on higher freight and distribution costs, higher sales of lower margin products, and shrink. And this company is actually rewarding shareholders currently because they just finished repurchasing 125,000 shares during the quarter with another $300 million remaining to spend on more shares. So personally, I expect a lot more aggressive buying here as we get into 2020. Looking closely here at their free cash flow from the quarter, you can see that after expenses, the company actually lost around $100 million, which was a big contributor to the sell-off the stock saw. However, on the year, free cash flow is still doing well and is still up year over year at close to $1 billion. Now I quickly took a peek here at the balance sheet to make sure we're in good standing despite this free cash flow concern. I noticed that cash positions shrunk heavily this past year, down from $1.1 billion to $422 million. However, digging deeper, they actually paid off all of their short-term debt, which justified why their cash balance shrunk so significantly this year. So I can give them a pass here. However, just take a note that long-term debt is still over $4 billion. Now this $4 billion is still manageable, especially if they can continue bringing in around $1 billion of free cash flow every single year. And really think it was a smart move by them by wiping out the short-term debt, because if we do enter a recession, the first thing investors are going to look at our balance sheets and debt loads, especially short-term debt. So when you look at a company like this and they have no debt anymore for short-term, it actually gives investors a lot more confidence to put money into the business, to invest, especially during hard times. But what's ironic here is that, like I said, I think this stock is actually going to do pretty well if we do see a recession in the next year or two. Now, analysts here see around an 18% upside in the stock, and I think based on the financials we saw, this stock may actually be a bit oversold at this point. Now, before I show you the current stock chart, let's take a look at Dollar Tree versus the S&P 500 during the last recession. Here we can see that we did see a decline in Dollar Tree prior to the recession, but once we were in a full-blown recession, the stock thrived. Notice how we had that big drop in late 2007 and then the recession hit in 2008. Is that foreshadowing what's happening today as well, where we see a big drop in 2019 and possibly a recession in 2020? I don't know, that's just speculation, but currently we're down around 26.5% from our highs, and this drop tends to happen every few years in Dollar Tree and has proven to be a very good entry point in the past. Will it hold up again? Well, that's anyone's guess at this point, but based on the fundamentals that I see, there's a strong chance that the answer to this question is yes. The 4P of the stock is around a 16, which is decent value, so fundamental indicators are actually showing me that this is a decent entry here in Dollar Tree. But that being said, let's not forget that the stock has actually run up from a low of $7 per share in the last recession to now around $90 per share. So can we go lower? The answer, of course, is yes, because anything is possible in the stock market. That being said, though, I think the Dollar Tree is actually an incredible stock here to keep a close eye on, especially if that recession does happen here in 2020. If you don't really have a recession-proof stock in your portfolio, this may be one that's kind of unconventional to hold because it isn't your typical consumer goods stock, like Pepsi, Coca-Cola, that kind of stuff, and it does give a bit more diversification as well. Now, moving on, stock number 2 is one that's in an industry that a lot of us use if we do travel. I personally have been using this company and some of their sub-brands as well. And the parent company goes by the name of Expedia Group, ticker symbol EXPE. Essentially, Expedia is a travel company and they own some of the most well-known brands out there when it comes to booking flights, hotels, rental cars, or anything travel related. Some of these popular names include, of course, Expedia website, Hotels.com, Trivago, and Hotwire, just to name a few. What I like here is that they operate in over 70 countries, so their revenue capability is essentially worldwide, and this is shown by their revenue, which 45% of it comes internationally. Now, some of the information here is a bit older, from 2018, however, they have access to over 1 million properties, 500 airlines, tons of car rental companies and cruise lines, and much more. In 2018, they almost cracked $100 billion in booking revenue, which generated them about $11 billion in revenue after they took their cut. And recently they released their Q3 results, once again showing strong growth with revenue up 9%, gross bookings up 9%, and both of these figures are healthy increases. In more detail here, we can see a breakdown of their Q3 highlights. Net income was the main red flag for me, which declined 22% in Q3, which is a fairly drastic drop, so we'll need to dig into this a bit deeper here shortly. However, they also repurchased some more shares, bringing their shares purchased year to date to 3.2 million, with 900,000 shares purchased in the last quarter alone. Their year-to-date free cash flow increased by 5%, or 15% if you exclude capex spending. And after sitting down and listening to the conference call, they outlined that the majority of their impact from their net income here was due to softer than expected results in North America and Asia. This particularly was seen in brands like Trivago and Vrbo, and some of the Asia concerns here were cited to be caused by macroeconomic events, aka potentially the trade concerns. This resulted, of course, in them lowering their fiscal year guidance, which investors were not happy about, and that resulted in a big sell-off in Expedia stock. They also seem to be struggling with SEO with certain brands like Trivago and Vrbo, which of course results in less traffic, and as a result that means less revenue and less profits. And although this may be something to make note of for the short term here, I believe that this brand is so strong and they're so diversified that this is not really going to impact them too much over the longer term. That's because if one of their brands like Trivago starts suffering, You have other brands like Expedia, Hotels.com, Hotwire that can pick up the slack here, because when consumers look for hotels, they're typically going to go to one of these brands, which ironically Expedia owns all of. Now, as of recording this video, the stock is up close to 7% on the day, but even so, analysts see about a 27% upside from current prices, signaling that we may be oversold here in the stock. As we can see, we're down around 40% from its all-time highs, thanks to a few bad quarters in the past, but the most recent earnings is what really hurt them. This could be an over-exaggeration, and in my opinion, based on the fundamentals I'm seeing, it's very possible. We're trading at a rich PE currently in Expedia. However, the forward PE here is around a 14, which is a lot more reasonable, especially considering the growth they just showed in the last quarter. Oh, and I didn't mention, this company is also a dividend stock. Although the starting yield is a measly 1.37%, don't discount this stock just yet, because their payout ratio is only around 23%, meaning they can grow this dividend much higher in the coming years. And guess what? They've actually been doing this. In the last 9 years, they've raised this dividend consecutively with an average growth rate of 17% year over year. And looking historically at their dividend yield here, which is something I like to do to see if we're finding good value in a stock, the only other time we saw such a high yield in Expedia was back in 2013, 2014, and that again was caused by soft earnings, where analysts ended up downgrading the stock. This is similar to what we're seeing today with the most recent earnings. However, even when we saw the drop in 2013, management was confident that long-term outlook, similar to today, was still looking good, and this is where the credibility and reputation of the management team plays a role in determining if Expedia is a good value right now for the future. Now, the big elephant in the room when looking at this industry and the stock is, of course, Airbnb, which has taken a huge share of this market and also plans to IPO sometime in 2020. I know a lot of people prefer Airbnb when they go and travel. However, me personally, I still enjoy the hotel experience. And I know there's a lot of people out there that are like me that will pick a hotel over Airbnb when they travel. However, it wouldn't be very smart of me here to discredit Airbnb and say that it doesn't impact the business, because that's simply not true. Airbnb has definitely stolen a good chunk of the market here, which Expedia and Bookings.com pretty much dominated before. And this is only going to get worse and more competitive as time goes on. However, this does not mean that there's room for multiple players. Like I said, people still prefer the hotel experience. People still prefer staying at, fancy 5-star hotels. And that's not going to change anytime soon, in my opinion. And what gives me confidence here in this business is that Airbnb has been around now for a few years, and they've already kind of gone to the market and said, we're here to stay, and we're going to be stealing a lot of your market share. And Expedia has said, well, fine, that's okay, we're going to keep operating, we're going to keep growing, and they've proven that with their revenue growth, as we saw year over year. So really, bottom line, competition is healthy, competition is good for us consumers, and I think that there is room for both of these companies, Airbnb and Expedia, to do just fine over the long term. So that's why I kind of picked stock number 2 as Expedia, because right now, based on the fundamentals that I'm seeing, this looks like a great value stock. Now, stock number 3 is actually one we've covered on the channel a couple times before, but I need to discuss it here because it is still a good value going into December 2019 here. That company is 3M, and ticker symbol is MMM. Now, in the interest of time, because like I said, we have covered this stock before, I'm actually going to go over the latest earnings report and highlight some key things here that excites me about this stock and kind of gives me more reason to invest heavier here in 3M. So the first thing we see, unfortunately, that sales is down 2% year over year, which is completely expected due to the slowing global growth. Now, 2% isn't too bad in my opinion. Many investors were expecting a mid to high single-digit drop here in 3M, so 2% drop is fairly modest in my opinion. EPS was up 5% year over year, which is good growth. Operating income was more or less flat. Again, all things considered, this is not a bad thing here for 3M. Free cash flow was $1.7 billion, which is a big reason I love this company. And the last thing was that they returned $1 billion to shareholders, which is again a big reason I love this stock. Now, breaking it down to segments, you can see the US was down significantly year over year in terms of organic growth. However, the real culprit here for the struggling sales in 3M is from China, with a 9.4% decline year over year. However, despite this almost double-digit decline in China, the company still was able to remain relatively flat overall in the business, which shows the benefit of having a company with such a large global exposure. Now, if we do end up seeing a deal with trade with China, we may actually see a flat year here in growth in China in 2020 with 3M, or if we're lucky, we may actually eke out a small gain as well. Both situations would actually benefit 3M overall significantly regardless. Now, I mentioned $1.7 billion in free cash flow and that they've also returned value to shareholders, and they've done this through a couple things, the first being stock buybacks of $142 million, and the second being through dividends of $828 million paid out. 3M is what's known as a dividend king, raising its dividend for 67 consecutive years. There aren't a lot of companies that are able to say this. The current yield is a respectable 3.5%, and the last 5 years it has grown by about 16.5% on average year over year. This is absolutely phenomenal performance from a company that is regarded as a boring company. But here's a perfect example of when boring can actually be good. Analysts on TipRanks feel that 3M is fairly valued. However, I think looking 5-10 years out, this stock is severely undervalued. They have a forward PE of around 17, which is well under the market average of around low 20s. And really, even from a charting technicals perspective, the stock has found support on the 100 moving average on the monthly. And as of now, you can see we're just kind of consolidating here as these global fears continue. But even so, I think 3M is holding up very well here, even though it's currently down around 40% from its all-time high. But all things considered, this business is actually still doing pretty well. 3M is one of those industrial stocks that I think can pretty much be in your portfolio forever. And just based on its dividend growth history, this is one that you'll want to hold in a dividend portfolio. Now, this is where I turn over things to you. I want to hear what stocks you guys would buy in December 2019. Let me know your thoughts on the 3 stocks that I covered today: Dollar Tree, Expedia, and 3M. And let me know what other stocks you're looking to buy here in December 2019. I don't really see too much value in the typical names that we've covered previously on the channel, which is why I had to branch out differently here and look at other stocks that other YouTubers aren't talking about either. So guys, if you enjoyed this video and you found value here, remember, drop that like down below. We're aiming for 550 likes on this video. But either way, don't forget to invest positively, and I'll see you in the next one. Peace.